So, you want to own a Renaissance banking house? Excellent. Merchants carry silver through your door before breakfast. Foreign coins cover the counter by noon. A silk dealer pays you to move money from Florence to Bruges without moving a single chest. A nobleman requests a loan large enough to buy your loyalty and perhaps your building. Your ledger shows claims on customers across Europe. Your vault looks reassuringly heavy. Then a courier bursts through the door with a protested bill. The Bruges payer has refused to honor it. At the same moment, 3 depositors arrive demanding their coins. The nobleman who owes you the most has stopped answering letters. On parchment you are rich. At the counter you may not survive the afternoon. So where did a Renaissance banker actually earn money? How much silver had to remain idle in the strong room? And which mattered more, the coins you possessed or the promises other people trusted? We will follow every florin through the house and see who keeps the final profit. Remove the marble lobby, printed banknotes, credit cards, and government insurance from your imagination. Our setting is Florence around the middle of the 15th century. This is not a modern retail bank waiting to issue mortgages and checking accounts. It is a merchant banking partnership operating inside a trading city. The owners exchange currencies, accept funds, settle payments, finance merchants, and trade through distant agents. Family capital may begin the company, but outside money can enlarge what it controls. International branches and correspondents connect Florence with places such as Rome, Venice, Geneva, Bruges, and London. Bills of exchange reduce the need to transport heavy coin across dangerous roads. Account books turn distant obligations into something the owners can attempt to measure. Renaissance bankers left account books, contracts, correspondence, court records, and evidence of bills and deposits. Those records reveal real institutions, but not one universal banking model. No complete profit and loss account survives for the fictional house in this video. Documented mechanisms will remain separate from modeled figures and genuine unknowns. Our imaginary company belongs to 3 partners who operate a Florentine head office and 1 distant branch. They handle exchange, deposits, commercial payments, merchant credit, and selected trading ventures. No printed money, central or deposit insurance waits behind them. When confidence breaks, the partners meet the crowd with their own reserve and their own reputation. Before earning anything, they need capital. The partnership agreement decides who contributes money and who receives shares of profit. It also decides whose judgment can expose everyone else to loss. One partner contributes silver, while the others contribute customers, experience, and foreign connections. The legal document creates claims among the partners, not trustworthy borrowers. Location helps. A counter near merchants, notaries, guild officials, and currency dealers receives more useful traffic than a grand room on an empty street. The office requires secure doors, shutters, locks, scales, desks, account books, wax, seals, and guarded storage. Coin must be counted where customers can watch without watching too closely. Couriers need somewhere to arrive soaked, exhausted, and carrying news worth more than their horses. The visible shop is only the front of the machine. The real bank extends through ledgers, partnerships, correspondence, and trust between cities. That creates our first open question. Is the vault the asset, or is the network recorded inside the ledger more valuable? Start with the simplest service at the counter. Florence receives coins from many places, each with different weights, purity, wear, and local acceptance. A merchant holding unfamiliar silver wants florins that suppliers will recognize. The cashier weighs the coins on a balance. He inspects edges for clipping and surfaces for suspicious color. He checks the quoted exchange rate before the customer becomes impatient. Good coins enter one tray, while doubtful pieces collect in another. The bank earns through the difference between its buying and selling terms. That spread looks tiny until many merchants cross the counter. One bad coin can erase the margin from several honest exchanges. A skillful money changer protects profit with scales, experience, and disciplined suspicion. Exchange income arrives quickly, which makes it valuable for daily cash flow. It also exposes the house to changing rates. A currency purchased today may be worth less when the next courier brings tomorrow's quotation. War, harvest failure, political conflict, and trade demand can alter what merchants will accept. The banker makes today's decision using letters already days or weeks old. Now a cloth merchant enters with a larger problem. He owes money in Bruges but does not want to send a guarded chest across Europe. Transporting coin creates wait, delay, escort expense, theft risk, and political risk at every border. The banking house offers a bill of exchange. The merchant pays florins while the banker writes instructions to a correspondent in Bruges. A courier carries the document instead of carrying the full value in silver. At the destination, the beneficiary presents the bill and receives payment in the local currency. The network transports value by balancing claims rather than hauling the original florins north. That service can combine payment, currency exchange, and short-term credit. It can also produce income through the exchange terms applied across cities and time. Church teaching condemned usury, especially straightforward profit, demanded merely for lending money. Bills of exchange involved genuine currency exchange, distance, timing, and commercial risk. Their exchange terms could also create returns resembling interest without stating a modern interest charge. Historians still debate how particular transactions balanced commerce, credit, and usury concerns. What matters economically is that exchange terms could reward the banker for time and risk. The merchant buys safety and access to distant funds. The banker sells the credibility of a payer in another city. That brings us back to the protested bill from the opening. A piece of parchment cannot pay anyone by itself. The distant payer must accept the obligation and produce usable money. If he refuses, the bill may be protested and returned through the network. The merchant blames the banker who recommended the route. The banker blames the branch that accepted the customer. The branch blames a debtor who has conveniently left town. Each letter moves faster than the money, but slower than the argument. Collection requires more letters, notarial work, travel, and paid attention. A delayed bill ties up capital that could have supported another trade. A failed bill converts expected income into a legal claim of uncertain value. The document moved value only while every important participant believed the next signature. Merchants and wealthy clients may leave funds with a trusted banking house for safekeeping and payments. The bank records what it owes each depositor. Those deposits are useful funding, but they are not free revenue. They are liabilities wearing the comforting appearance of coins in your room. Some payments can be completed through account transfers rather than physical coin. One client's balance falls while another rises, allowing the clerk to move value with ink. It also makes correct records absolutely essential. One misplaced digit can transfer a week's confidence to the wrong person. The head clerk checks names, dates, currencies, counterparties, and authority to withdraw. The cashier confirms that the person at the counter has authority to use the account. Trust must therefore be supported by recognition, witnesses, seals, letters, and records. The bank can put deposited money to work through trade and credit. If every coin remains untouched, the house earns little from holding it. If too many coins leave the vault, the house cannot satisfy withdrawals. The profitable reserve is therefore never obvious. Idle silver protects confidence, but produces no direct return. Deployed silver may earn income but cannot answer the customer who wants payment now. This is the second open question. How small can the reserve become before efficiency turns into panic? Daily operation depends on skilled labor. The senior partner chooses customers, negotiates large transactions, and protects political relationships. The head clerk supervises journals, ledgers, letters, and reconciliations. Cashiers weigh coins and manage the visible counter. Couriers carry instructions across mountain roads and contested borders. Their wages arrive whether the distant debtor pays or not. Paper, wax, ink, rent, security, meals, horses, and travel create steady operating costs. Mistakes create irregular costs with much sharper teeth. Suppose a junior clerk posts a payment in florins to an account measured in another currency. The ledger still balances beautifully if the error is copied twice. The customer will discover its beauty at exactly the wrong moment. Internal checking is therefore not decorative administration. It is maintenance performed on the bank's invisible machinery. Branches make that machinery larger. A branch in Bruges places staff near northern merchants, wool, cloth, and international payments. It can attract local deposits, arrange exchange, finance trade, and settle bills. It also creates distance between the owners and the decisions made with their capital. The branch manager sees customers the Florentine partners have never met. He can approve a transaction before the head office receives the previous month's accounts. Correspondence is slow, and consultation is slower. By the time Florence orders caution, the branch may have extended another large credit. This creates the third open question. Does the branch multiply the owner's reach, or merely multiply the places where money can disappear? Imagine the Bruges manager receiving a court official in expensive clothing. The official requests financing connected to a powerful ruler. He also makes refusal feel politically unhealthy. The branch manager approves more than the partnership rules intended. Weeks later, the head office receives a beautiful explanation, followed by another request for patience. The ruler receives goods and influence immediately. The bank receives promises arranged in increasingly impressive stacks. Powerful borrowers can be the largest accounts and the weakest collections. Ordinary merchants fear losing the bank, while princes assume the bank fears losing them. Credit analysis therefore mixes commerce with politics. Collateral is not useful when enforcing it invites confiscation of your branch. Prestige can attract customers, but prestige cannot be counted into the reserve chest. The noble loan from the opening now has its answer. It looked profitable because the amount was large and the relationship looked valuable. It became dangerous because the borrower could delay payment more easily than the bank could demand it. Concentrated credit turns one impressive client into a threat to every ordinary depositor. Merchant banking also overlaps with trade. A house may finance wool, cloth, alum, silk, spices, or other commercial ventures through partnerships and agents. Trade profits can exceed simple counter fees. They also introduce inventory, shipping, price, and quality risk. It occupies storage, absorbs transport costs, and may arrive wet or damaged. A shipment sold at a high price creates profit only after freight, duties, commissions, and losses are counted. A full ledger of receivables measures claims, not available cash. The bank is therefore part exchange house, payment network, creditor, accountant, and trading company. Diversification can smooth income when one activity weakens. It can also hide which activity is quietly consuming capital. Now return to the branch accounts. The head clerk places the Bruges ledger beside letters from local merchants. One payment appears collected, but the customer says his agent never received it. Another entry lists valuable cloth at a price no recent letter supports. A third claim has been carried forward so many times that delay looks like an asset. Optimistic accounting can still manufacture imaginary strength. The partners send an auditor with instructions to inspect cash, bills, goods, and customer balances. The auditor arrives to find an impressive desk and several debtors promising payment next week. Expansion works only when information and control grow with it. Now test the whole machine under pressure. A rumor crosses the market that a large Florentine house has lost money abroad. That distinction disappears as depositors begin walking toward your door. The cashier pays the first modest withdrawal without hesitation. The third brings two servants and asks for his entire balance. People outside notice the servants carrying coin. The line doubles before the head clerk can finish one account. Meanwhile, a soaked courier arrives with the protested Bruges bill. Another letter reports that a wool shipment sold below expectation. The branch asks the head office for emergency funds. The powerful borrower sends apologies instead of payment. Together, they convert slow assets into an immediate cash problem. The bank owns bills, loans, goods, and distant claims. The crowd wants florins now. The senior partner orders the cashier to pay small withdrawals first. He sends messengers to friendly houses seeking short-term assistance. He offers a sound commercial bill in exchange for immediate coin. One banker agrees, but demands painful terms. A depositor pounds the counter and accuses the house of hiding money. Guards close the shutters without striking anyone. Closing protects the remaining coin and announces fear to the entire street. The house may be solvent if every debtor eventually pays, but eventually is not this afternoon. Trust created the network, and distrust compresses every distant promise into one local demand. Now build a financial model without pretending to recover an exact Renaissance account. These are modeled units, not recovered historical prices. The figures simplify exchange, payments, credit, trade, and branch operation. Begin an ordinary year with 100 modeled units of operating revenue. Currency exchange spreads contribute 26 units. Bills of exchange and payment services contribute 24. Commercial credit and commissions contribute 18. Trading partnerships contribute 16. Depository, custody, and account services contribute 8. Miscellaneous agency work contributes the final 8. Deposits themselves are not counted as revenue. They are money the house owes back to customers. Now count ordinary costs and losses. Clerks, cashiers, apprentices, and guards consume 17 units. Couriers, horses, and correspondents consume 8. Rent, security, paper, wax, and equipment consume 7. Branch overhead consumes 13. Currency losses and bad coin consume 6. Legal, guild, tax, and notarial obligations consume 7. Ordinary credit losses consume 12. Trading losses, damaged goods, and unpaid commissions consume 7. The opportunity cost of maintaining a usable reserve consumes 7. Total modeled cost reaches 84 units. The ordinary operating surplus is 16. The room looks wealthy because it handles far more than 16 units of other people's money. The owners keep only the residual after wages, agents, claims, and losses are satisfied. Now examine liquidity separately from profit. Imagine the house controls 200 units of assets funded by partner capital and customer deposits. 70 units remain in coin or claims that can be converted quickly. 80 units support bills and merchant credit. 35 units sit in trading goods and slower receivables. 15 units support premises and working operations. If depositors request 40 units, the reserve can answer them. If they request 90 units together, profitable long-term claims do not solve the counter's problem. Selling those claims quickly may require a heavy discount. Liquidity is not the same as wealth. It is wealth available before patience expires. In a good year, trade expands and trusted bills settle on time. The branch attracts strong merchants rather than flattering rulers. Modeled revenue rises to 154 units. Higher labor, travel, reserves, and trading volume raise total cost to 111. The modeled surplus reaches 43. Partners celebrate the network that made distant income possible. Success encourages them to accept larger bills and thinner reserves next year. The good year, therefore, plants a very elegant seed of overconfidence. An ordinary year returns 100 units of revenue against 84 in cost. 16 units remain for partners, reserve growth, and future losses. That is respectable but smaller than the mountain of transactions suggests. Now the weak year brings slower trade and unfavorable exchange movements. Two merchants delay payment while branch expenses continue. Modeled revenue falls to 61 units. Wages, rent, correspondence, legal work, and basic reserves cannot disappear immediately. Modeled cost remains 83 units. The house loses 22 and survives by consuming partner capital. The counters still open each morning. The polished routine conceals a shrinking cushion. Finally, combine the wrong borrower, the wrong branch manager, and the wrong roomer. A powerful debtor defaults on a concentrated loan. The Bruges branch reveals overstated assets and unpaid bills. Trading goods sell below their recorded value. Depositors request coin while the best assets remain distant or frozen. Usable modeled revenue collapses to 24 units. Operating expenses, credit losses, branch losses, and forced discounts reach 139. The modeled loss is 115 units. Customer withdrawals create an additional liquidity demand of 70 units. That withdrawal is not an operating expense because the deposits were always liabilities. It is still enough to empty the available reserve before assets can be collected. The house can fail while owning claims that look valuable in the ledger. Partners may lose invested capital, political standing, and control of the business. Depositors may recover only after a long and uncertain liquidation. Workers lose employment even if their own entries were perfect. The catastrophic outcome solves our reserve question. The minimum safe reserve was not a fixed pile of coins. It depended on withdrawal behavior, asset quality, payment timing, and confidence. Now answer who performs the work and who keeps the profit. Cashiers detect questionable metal one coin at a time. Clerks turn scattered promises into records the partners can inspect. Couriers carry the information that allows distant claims to function. Branch employees build relationships the owners cannot personally maintain. Merchants supply transactions and accept the risk of long-distance trade. Depositors supply funds while expecting access and safety. The partners contribute capital, legal responsibility, networks, judgment, and the final financial cushion. Employees usually receive agreed wages before the year's result is known. Depositors retain contractual claims rather than a share of every success. Trading partners receive whatever their agreements specify. The banking partners keep the residual only after all prior claims and losses are recognized. In a good year, that residual can be substantial. In a bad year, ownership concentrates the loss at the same table that once divided the profit. So could owning a Renaissance banking house make you rich? Yes, if your network moved payments reliably, your clerks controlled information, and your borrowers respected their promises. But the business did not become rich by stacking silver inside a room. It earned money by exchanging currencies, settling distant payments, financing commerce, and making trusted claims useful. The vault protected confidence. The ledger organized obligations. The branches extended reach. The couriers moved information. The reserve bought time. The most valuable asset was the belief that a promise written in Florence would become money somewhere else. The largest danger was discovering that everyone wanted proof of that belief on the same afternoon. The coins were visible. The network was the business. The ledger was the machine. And trust was the capital no strong room could replace.